thanks for staying with us. It's time to take our viewers' questions and help them fix their portfolios. Sumeet Vaid from Ffreedom Financial Services is on the show today for the Q&A session. Sumeet, thanks for being with us. I'm going to go across and welcome in our first caller. He's BT Raghavendra from United Kingdom, UK. Hi Raghavendra, go ahead. How can we help you?
Hi Manisha and the team. Well, I have a quick question about the ULIPs, because I've always been watching your show and you mentioned that ULIPs is not a good investment, but unfortunately I have invested in ULIPs for about 1.5 lakhs per annum, and it's been 3 years now. So the question is, should I continue investing in the ULIPs, or should I discontinue? Because what I've heard from the agents is that they keep giving you loyalty bonus after 4 or 5 years, which is like you recover all your charges during that period of time. And apart from that, I have also sent you a list of mutual funds that I've invested in, and if you could go through it and let me know whether I'm in the right track, that would really help.
Okay, Raghavendra. So we're going to start with looking at a quick look at your portfolio. So you've got HDFC Children Gift Fund, 2 of those, ICICI Pru Focus Blue Chip, ICICI Pru Dynamic, HDFC Top 200, and Prudential ICICI Infrastructure Growth Option, Prudential ICICI Discovery Fund. So those are your mutual fund portfolio. But should you get out of ULIP? Well, Sumeet, what can I say? I was told the exact same story by exactly the same company. We don't want to go into the name of the company. 3 years, at the end of 3 years of my investment, that don't worry, you'll recover your charges. 6 years later, I had to get out at almost 8 to 10% loss.
It's a never-ending game, Manisha. Though things are changing and changing for good in India, we've known that. We have talked about it in your show number of times, but it still continues. And in this case, for Raghav, it's a bigger decision because he's already paid premium for 3 years. So it's very difficult for even an advisor to go and tell him, okay, you stop and incur losses on whatever you have invested and go forward. But the bigger part which we need to really understand out here is the exact date when you really started. Because as per me, the regulatory changes which have happened in the ULIP regulations happened around about 3 years ago, where the lock-in has moved from 3 to 5 years. So if we had the exact date, we could have advised you much better in terms of trying to tell you whether you can have an option of even stopping, or you have to go on till 5 years before you really stop and move ahead. Having said that, at a basic fundamental level, my advice will be don't incur losses. Continue as long as you will incur minimum amount of losses if you have to exit out of this particular unit-linked plan. And exact details of this can be provided to you if you call up that particular insurance company, not your agent. So avoid calling the agent who gave you this particular product. Go and call the insurance company. They'll really help you give the right perspective that whether if you exit right now, what will be the kind of losses, and if you can, in fact, whether you can exit right now or all, and take it up from there. So that's the first advice. The second, with respect to your mutual fund portfolio, if you really look at, you've got good quality products there, good quality mutual fund. The ICICI Pru Focus Blue Chip Fund, fantastic fund. Continue, no doubts about it. ICICI Pru Dynamic Fund, one of a better performing funds for some point of time. Continue there. There's not at all a problem with that. HDFC Top 200, again a very good fund. No need for you to think about coming out of that fund. Prudential ICICI Infrastructure Fund. Now this is one place where you need to really understand that as an individual investor, it's very difficult for us to really track any sector or theme. Infrastructure is a sectoral/thematic fund. Where we are trying to take benefit by investing in a typical theme, and somehow in India for last 4 or 5 years, the infrastructure theme has been talked about, the story is what the future story is, but returns have not been really good. In fact, many of them have been negative. So this is one fund which we'll advise you to really think about and exit if possible to do that. Prudential ICICI Discovery Fund, Growth, great fund, stay put. So out of all these things, if you really see, immediate action required is on the infrastructure, and with respect to ULIP, go back to the insurance company, not to the agent, and do a rational decision out there rather than trying to do an emotional or knee-jerk reaction of coming back or staying in.
All right. So am I understanding clearly, Sumeet, that in case his lock-in period is over, it's preferable to actually book a little bit of loss and get out of the ULIP? If its lock-in is not over, then continue with it?
That's right, Manisha. That's right.
Okay, but yes, Raghav, as soon as you can get out of a product which is not performing well, I think you should cut short your losses. Just waiting for it to make good your losses isn't a very good investment strategy on your mutual fund portfolio. Clear guidance, don't look at sector funds, especially infrastructure, even though lots been written about the infrastructure story in India saying it's bottomed out. From now on, you should only see better days. But we still say, why? When you have good diversified equity funds, especially in your portfolio, you own some really good ones, why bother with a sector fund? So even if you're making losses there, cut out and move into some of the well-performing diversified funds. This is an email from Pramod Shah, 32 years of age, Raipur, has a homemaker wife and a 3-year-old daughter. Pramod also co-supports his parents, which is a lovely thing to do. Pramod's monthly savings are 25,000 rupees and he wants, Sumeet, your help to achieve a goal of 1.5 crore for his daughter's education and marriage, which is 18 and about 22 years away from now. And he also wants 5 crore for his own retirement by 2040. So his first question is 25,000 rupees enough to meet his goals? And then how should he distribute it?
I think, Manisha, I'll start off by congratulating Pramod. You know, very specific questions, clarity of goals. He knows exactly what his expenses are. He knows exactly when he's retiring. I think that's the first fundamental clarity which is required for any family to be successfully financially over a period of time. So I think congratulations. Continue doing that, and to all other viewers who are watching us, please follow this example. This clarity is very important. When we go into the goals for Pramod and try and figure out and divide them into retirement and marriage, for retirement, which is 5 crores by 2040, you need to do a systematic investment plan of 9,500 rupees only, because you've got huge number of years, close to 28 years to really go and accumulate that kind of thing. And that 9,500 of systematic investment plan should be increased by 10% every year. The logic for this increase is your income is going to increase as you grow from one position to another over a period of time. Hence your investments and savings should also increase. And this 9,500, which is a systematic investment plan we are recommending, should be split into the various asset classes, which is 70% in equity, diversified equity fund, 20% in fixed income, and 10% in gold fund, which can be ETF or others. The product which we'll recommend for equity side will be DSP BlackRock Equity Fund, HDFC Top 200, IDFC Premier Equity, and on the fixed income side, Birla Sun Life Dynamic Bond Fund. And for gold, you can pick up any ETF or Reliance Fund of Fund. Ideally, a fund of fund works much better because you can do systematic investment plan. Similarly, if we try and see your marriage goals for children, which are very, very doable. So first goal of marriage is 1 crore 50 lakhs by 2030. For that, you just need to do an SIP of 13,000 rupees. Again, in the same order of 70% in equity, 20% in debt, and 10% in gold. You can choose the same funds and continue to do that. And then for your the second child, which is 1 crore 50 lakhs in 2035, what you need to do is only 6,000. Now, this is the interesting one which I want to really highlight. Both the amounts are same, 1.5 crores. One is required in 2030, the other is required in 2035. The difference is only 5 years. See the difference it does in terms of amount. In the amount which is for 1 crore 50 lakhs, for 2030, you need to do 13,000 rupees of SIP. In the one in which you require in 2035, you only need to do 6,000 rupees. That's the power of compounding. And we need to have the discipline of starting early and staying put in this. So, both these SIPs, in fact, all three SIPs which we are recommending should be in the order of 70% in equity, 20% in debt, and 10% in gold. And the funds which I have told you on the equity side is DSP BlackRock Equity, HDFC Top 200, IDFC Premier Equity on the equity side, fixed income Birla Sun Life Dynamic Bond Fund, and on the gold it can be any fund of fund gold option, either with Reliance or any other AMC like Kotak, etc.
Right. Well, Sumeet, very well laid out plan there for Pramod. Thanks very much for joining us here on Let's Talk Money. Pleasure to get your views.
Sure. Thank you.
We also constantly remind our viewers that bundling insurance